What if you could actually make significant, measurable gains in just 3 minutes? Not some lucky fluke, right? But a really meticulously planned and, well, perfectly executed strategy. Imagine a situation where the market's own volatility, usually something you see as risk, becomes this powerful engine for really rapid profit. Today, we're doing a deep dive into exactly that kind of event. We're looking at the trading session of September 5th, 2025. This wasn't just, a good day. It was actually described as a textbook example of dynamic convexity execution. And the wild part, it all unfolded in just 180 seconds right after the market opened. So our mission here today is to really peel back the layers, unpack how this ultra-efficient convexity capture day actually happened. We'll dig into the market forces, the sophisticated systems involved, and pull out those critical lessons on precision, speed, discipline, things you can use to understand these fast markets better.
Yeah, what's really fascinating, I think, is that this wasn't just rolling the dice. It wasn't luck. It was this perfect alignment of, well, very complex systems, and they were reacting with almost surgical precision to a very specific, very rapid market shift. It's really a story about turning potential fragility in the market into an opportunity for incredibly swift, substantial gains.
Okay, let's set the scene a bit then. Before the market even opened that day, the early analysis was already painting a picture. It suggested what traders call a defensive regime, which for most people means, proceed with caution. The SPY, which we often use as an anchor for the S&P 500, it looked kind of bullish, moderately so. But interestingly, Tesla, TSLA, was initially flagged as bearish.
Bearish initially.
Yeah, and Bitcoin, through its ETF mini, was neutral. The VIX, the fear gauge, was pretty calm, sitting around 15.30. So this initial outlook actually suggested lower market exposure, maybe favoring protective puts, a conservative stance. But, and here's where it gets really interesting, where the whole script for the day just flipped. A little later in the pre-market, there's this critical update on TSLA. Suddenly, its price surges. Jumps to $344.95. That's up 1.90% from where it was just a bit earlier.
Wow, quite a jump.
Exactly. And that single move completely invalidated the early bearish view. Suddenly, TSLA isn't just above its open, it's above all its key moving averages. Its VWAP, which was $344.88.
Right.
And the Bollinger Bands, the volatility measure, they were forming a squeeze.
Ah, the squeeze. Classic signal.
Yeah, indicating imminent volatility expansion like a coiled spring. And even though one indicator, stochastic, showed overbought, other momentum indicators were flashing strong positive signals. Real power behind the move.
Well, this brings up a really important question, doesn't it? For anyone trying to read these signals, how could one single asset's reversal, I mean, even a big one like TSLA, how could it so profoundly shift the perception of the entire market regime?
Right, from defensive to what?
Exactly. The answer is in its role as an amplifier.
Hmm.
This TSLA momentum flip, especially when you combine it with SPY and BTC already kind of leaning bullish,
Yeah.
it created a synchronized signal that you just couldn't ignore. The whole market stance shifted, and shifted fast,
Yeah.
from defensive, cautious, to a maximum bullish confirmation, a full risk-on environment.
So not just a small adjustment.
No, a wholesale change. And as a result, the capital allocated for trading, which started conservative, maybe 10.2%, was immediately ramped up, right up to the maximum, 20%, to really seize this confirmed opportunity.
Okay, so to really get how these assets work together, maybe think of it like this. SPY was the anchor, the big ship, providing the stable, broad market direction.
Setting the course.
Exactly. Then TSLA, known for its high volatility, that was the amplifier. Once it turned bullish, it could magnify returns like crazy, the speedboat racing ahead.
Making waves.
Right, and the BTC ETF Mini, that was the gatekeeper. Its movement often confirms or even leads sentiment across other assets, kind of an early warning for risk appetite.
So when all three line up,
It's a powerful confirmation, a really strong signal for a broad market move. So, okay, market sentiment is clearly risk on. These key assets are all pointing upwards. The next step was deploying a very specific strategy. Let's unpack this core idea, convexity. It sounds academic, maybe a bit intimidating. Can we break it down simply?
yeah, let's try. Imagine betting on a coin flip. Heads, you win $100. Tails, you only lose $10. That difference, that imbalance between potential gain and loss, that's what traders call asymmetric returns.
Okay, much bigger upside than downside.
Precisely. Convexity in options trading creates this nonlinear relationship. The options price can accelerate, like way faster than the underlying asset's price moves. It lets you structure trades to capture those huge asymmetric returns, but really efficiently. And if we connect this to the bigger market picture, These convexity plays often work by leveraging specific market dynamics. For SPY, it involves something called dealer short gamma.
Okay, what's that in simple terms?
Well, think about market makers, the people selling options. They have to hedge their positions. If they are short gamma above a certain price, say $650 for SPY in this case, it means as the SPY price goes up, they're actually forced to buy more SPY to stay hedged.
Wait, so their own hedging makes the price go up even more?
Exactly. It turns them from neutral players into participants who actually accelerate the move. It's a powerful tailwind.
Okay, wow.
Now, for TSLA, it was a bit different, but just as potent. It was about capturing IV expansion, implied volatility. Its FARV was at the absolute bottom, the 0% percentile, historically low.
Meaning it could only really go up from there.
Pretty much. When IV is that crushed, it has massive potential to expand, to snap back. And that expansion alone could drive huge gains, maybe 50% plus, even if the stock price itself barely moved.
And this whole approach was part of something called controlled fragility trading. That sounds like a contradiction almost. Controlled fragility.
It does, doesn't it?
It used a barbell convexity model. Can you maybe elaborate on that? How does this barbell let you be aggressive but still manage the risk, the fragility? Feels like a tightrope walk.
That's actually a great way to put it. The barbell model is about balancing extremes. Think of a real barbell, heavy weights on each end.
Right.
Those are your aggressive, high upside, long calls, seeking that explosive convex payoff, big potential gains. But the bar connecting them, that's your incredibly disciplined, almost paranoid risk management.
A safety net.
Exactly. You have big exposure to the upside, but equally strict preset rules to cut losses fast if things turn, protect the core capital, make sure chasing volatility doesn't become just reckless gambling. And they had already pinpointed these high probability zones for entry. SPY, $648, TSLA, $345, BTC ETF at $49.05.
Not just random guesses then.
No. Scientifically derived sweet spots based on their models.
And it sounds like the technology was crucial here. Their systems, Alpha Core v3.16, DOTAS v2.0, OMNI-Profit Nexus, these weren't just helpful tools, they were essential.
Absolutely essential. They weren't just separate programs crunching numbers. They acted together, like a unified ultimate trading protocol, constantly validating that risk-on regime in real time, confirming the signals, and ensuring just surgical precision in the entries, what they call tiered entries and immediate convexity payoff.
Like a perfectly synchronized orchestra, just waiting for the signal. Okay, so the market screening, risk on. The systems are aligned. The convexity strategy is ready. Entry zones identified. But what was the final trigger, the absolute green light for these explosive convexity plays? What confirmed it was optimal time for action?
That final critical green light, it was a sudden significant collapse in the VIX.
The fear index.
The fear index. It didn't just drop below 15, it was sitting around 15.30, but it was also trading below its 10-day moving average and historically in the 34th percentile. That combination, it signaled profound the ALM.
Okay.
This VIX suppression, as they called it, was the absolute critical signal. It confirmed the market had decisively shifted from that fragile state where fear dominates to a robust risk-on environment. Participants were willing to take on more exposure. For these traders, it meant the time was absolutely right for aggressive, short-duration trades. They knew underlying fear was low, and that would likely amplify any positive moves.
So you have to picture this incredibly compressed action. Market opens, 9:03 a.m. Eastern, bang! And then in roughly the next 3 minutes, 3 successful trades, initiated and closed.
It's almost hard to believe how fast it was.
Yeah, absolutely decisive. This wasn't about holding for hours or days. Surgical strikes. Let's look at those specific trades. What were they and why those ones in that tiny window? First, a TSLA $345 call option, expiring that same day, September 5th.
A 0 DTE, zero-day expiration.
Very sensitive.
Right, and executed specifically as a core amplifier breakout contract. It confirmed that crucial fragility flip. We talked about TSLA breaking key levels, signaling the shift.
Capturing an initial burst.
Exactly. Closed with plus $55 profit, plus 8.80% gain, just like that.
And they didn't stop there with TSLA. Right after that first confirmation, a second trade. A TSLA $350 call, also for September 5th expiry.
Another 0 DTE. Yep. This one was tagged as a momentum add-on to the core convexity ladder. It was only triggered after TSLA clearly reclaimed that critical $340 level, confirming the upward push. That closed with plus $35 profit, a plus 9.10 cent gain, and it lined up perfectly with what the systems call a memory overlay of that $345 range, a historically significant zone.
Okay. 2 on TSLA.
The
Okay.
third completed the picture, a BTC $51 call, but this one expiring September 19th, a bit further out.
Okay, why BTC?
This is called a convexity extension trade. It pushed beyond the BTC ETS $49.05 threshold. It confirmed Bitcoin's role as that leadership trade we mentioned, showing broad cross-asset risk appetite. It wasn't just following, it was helping lead.
And the result on that, right?
Impressive. Plus $64 of profit and ARM plus 11.95% gain, really cementing that risk-on feeling across the board. So, I mean, the numbers for this short period are just stunning. Total P&L plus $154 across those 3 trades, average gain plus 9.95% per contract, win rate 100%, flawless execution.
All in about 3 minutes.
All within about 3 minutes of the open. It really validated the system, the synchronization, a true textbook dynamic convexity execution. It showed the power of precision and speed.
So what's the takeaway here for you, the learner, watching these markets that move so incredibly fast? I think it means that these convexity scalps, as they called them, they don't need long exposure times if you execute at exactly the right trigger point.
Right. Get in, get out.
Exactly. You don't need your capital tied up for long. Time efficiency was key here. It showed that incredibly short exposure, literally minutes, can be super effective with precise, pre-identified triggers. Be present, be decisive, then step back. Now, okay, hearing about gains like that so fast, it might sound almost reckless, right? Like just gambling.
It could sound that way, yeah.
But this strategy, even though it was explosive, was actually built on really rigid risk discipline. They had these built-in braking systems. It wasn't about huge, wild risks. It was about surgically managed opportunity.
Absolutely. That risk management was non-negotiable. It was baked right in. For example, capital exposure, strictly capped. Around 20% of the total allocation for this strategy.
Not throwing everything at it.
No way. And that cap was crucial. It ensured profits could be taken without hitting those fragility triggers points where the market could suddenly become vulnerable again. And they had hard stop losses predefined. SPY below $645, sell. TSLA below $342, sell. BTC below $110 K spot, sell. Lines in the sand.
So individual stops for each asset. But what about the whole picture? What if the entire market environment just suddenly soured? Did they have protection for that?
They did. Beyond those individual stops, there was a global kill switch, the ultimate safety net. It would trigger only if SPY dropped below $635 and the VIX spiked back above 18.
Both conditions needed.
Both, if that happened. Immediate flattening, close all the long positions, protect capital above all else. And even within the risk-on phase, there was another contingency. If VIX just jumped above 16.5 or 17.5, they'd initiate a UVXY hedge.
An insurance policy.
Basically, yeah. A position to profit if volatility suddenly spiked, protecting against shocks. Plus, strict timing windows. Enter between 9.3 and 10.00 a.m. ET. A Fed speech guardrail cut back exposure before expected announcements. And a hard rule? No new 0D PE positions after 3.00 p.m. ET. Avoid that risky late-day action.
Wow. Okay, so these meticulously planned protocols, they really show that even when you're moving fast, high conviction. Discipline isn't optional. It's not an afterthought. It's the absolute foundation for success.
It's the hidden strength.
Yeah, it allows those rapid gains to actually be captured and, more importantly, kept. So as we wrap up this deep dive into really a remarkable 3 minutes of trading, what are the enduring lessons? What should you, the listener, take away?
I think there are a few really key takeaways. First, the VIX. It really is a primary catalyst. That move below 15 was the clear green light for explosive convexity. It signaled the environment was right.
Okay.
Second, time efficiency. These convexity scalps don't need long exposure if you hit the right trigger. Quick, precise entries and exits, driven by clear signals, incredibly powerful.
Get in, get out.
Exactly. And third, even after a perfect session, a 100% win rate day. Rigid risk discipline is non-negotiable. Always. And crucially, the analysis itself warned against 2 big pitfalls. 1, 100% win rates, not sustainable long-term. This is a unique situation, not a guarantee.
Manage expectations.
Right. And 2, quick gains breed overconfidence. It specifically warned against increasing position size just because of this one amazing success. These aren't just market lessons, they're psychological ones too.
This whole deep dive into just 3 minutes, It really reveals this fascinating, intricate dance between lightning-fast signals, advanced systems, and maybe most importantly, that unwavering human discipline. It really leaves you wondering, doesn't it, in a world that just keeps getting faster, where opportunities flash by, how do we balance chasing that rapid, high-leverage opportunity with, well, the timeless wisdom of caution? Of self-awareness.
Yeah.
It's a question that goes beyond just finance, really. It applies to so many decisions we make. Reminds us that speed needs strategy, and it always needs a deep respect for risk.